Hey guys, and thanks for tuning in to our pre-class lecture video, I guess, dealing with Chapter 16, which deals with financial leverage and capital structure policy. So what I wanted to do is just kind of breeze through the PowerPoints, kind of point out a few important topics that we're going to discuss more heavily in class. So again, the idea is to kind of give you an overview of what the chapter is about and to point out some things that that you should know going into class because we'll discuss those topics a little further. So chapter 16 again deals pretty much with financial leveraging, right? And it deals a lot with what are the effects of financial leveraging, right? There's a few calculations and whatnot that we'll get into in class, especially the M&M proposals and how to calculate leveraging and capital structure and things like that. This chapter also gets into the impact of taxes and bankruptcy on capital structure choices. So we'll go through the PowerPoints and I'll point out a few things. And again, like I said, we're going to expand on that a lot more when we get into class. And then finally, the chapter really finishes up with the essentials of the bankruptcy process. So capital structuring, right? What exactly is capital structuring and what are we talking about? Well, we introduced capital structure, chapter 12, 12 or 13, can't remember off the top of my head. But anyways, capital structuring just really talks about the amount of debt and the amount of equity. And I think we're good on that. But what we're going to see as we go through this chapter that corporations can actually restructure, right? And what they're looking to do here is to change the capital structures, right? So what we want to do is recognize that we as corporate managers or finance managers have the ability to change or to make changes in capital structure, but those changes are going to affect the value of the firm. Okay, so we need to keep that in mind. When we're looking at the capital restructuring, basically what we're doing is we're changing the amount of leverage, really, right? We're assuming debt and getting rid of some equity. Okay. And we can do this without actually changing the firm's assets, okay? Up to this point, we pretty much talked about, hey, you know what? We got a project. We want to invest in a project. We want to buy an asset, whatever. How are we going to do that? Are we going to use debt or are we going to use equity, okay? And up to this point, we pretty much said, oh, okay, well, we can use equity to finance or we can use debt to finance. Now we're kind of changing gears and we're saying, okay, we can take on debt to get rid of some of the equity that we have. Okay, so basically what we do is, and especially in this capital restructuring, is we increase or we leverage, right? We increase the firm's leveraging power by issuing debt. And from the proceeds that we get from that debt, guess what we're going to do? We're going to buy some outstanding shares, okay? So we can increase leverage by using more debt or taking on more debt. We can also decrease leverage. Well, how do we decrease leverage? Well, very simple. If we increase leverage by using debt to buy outstanding stock, to decrease leverage, guess what we do? We do the total opposite. We issue new shares. And that money that we get from issuing new shares, we use that to retire that debt that we have outstanding. So we're going to get into, hopefully, the idea is to get into a thick and rich discussion on choosing a capital structure. right? So the first thing you got to recognize is that when we're choosing a capital structure, our entire goal is to maximize our stockholders' wealth. That's what we want to do, right? We learned way back in, well, last semester, I think it was like the first or second chapter, right? We said, what's this financial management, right? And what are our goals of financial management? Well, or being a finance manager, we said, hey, we want to put more money in the owner's pockets, right? We want to maximize our shareholder wealth. When we're choosing a capital structure, that same concept comes into play. How should we structure our capital for our company, for our corporation or our company? Well, we're going to do whatever maximizes that shareholder wealth. Okay. Excuse me. So, I think it was chapter 14. We introduced WACC, right? Weighted average cost of capital, right? We saw how to calculate that, and maybe we'll work on a couple problems in class on Monday, just to kind of as a refresher. But how do we maximize shareholder wealth? Well, guess what? WACC comes into play. In order for us to maximize our shareholder wealth, we do that by maximizing the value of the firm. That makes sense. We want to increase the value of the firm, which in turn increases shareholder wealth. But WACC comes into play here, okay? If we minimize our WACC, that actually increases or maximizes rather our firm value as well as our stockholder wealth. Okay. Now remember what WACC is, right? It's the appropriate discount rate for the risk of the firm's assets. Okay. And we find that the value of the firm, by discounting the firm's expected future cash flow at that discount rate. Okay. So basically the what we're doing here is we're taking the process of finding the value of the firm, right? And we've already done this. We've already used net present value, right? What are those expected future cash flows? Well, let's discount them back to today. Okay, we did that for projects at the end of last semester, or whenever you had introductory corporate financing that happened towards the end. So basically, we're doing the same thing here, right? To figure out what the value of the firm is, and remember that WACC, that's that discount rate. Okay. Remember, value and discount rates actually move in opposite directions. So that's very important to remember to kind of understand why decreasing WACC or minimizing our WACC increases our value. Okay. It's because that value and discount rates move in opposite directions, right? The firm's value is going to be maximized when the weighted average cost of capital is minimized. Okay. And remember that a firm is just a portfolio of projects, okay? Some of those projects are going to have positive net present values, and some are going to have negative net present values, right? And this is what we find when we're evaluating these projects using WACC, okay? So when we get to class, we're going to work on some of the equations and whatnot that you picked up in the chapter. So we're going to look at and we're going to talk about how does leverage affect earning per share and ROE, right? Return on equity. So we're going to see that by leveraging, our earnings per share are going to be impacted, as well as the return on equity is also going to be impacted. Okay. So remember, this whole capital structure involves debt financing, right? Taking on some debt so we can cash out some of our stockholders. Okay. So when we increase the amount of debt financing, what are we doing? Well, we're increasing our fixed interest expense, right? Because remember, we issue a bond. That bond has a coupon rate, 6%, 5%, 8%, whatever, it doesn't matter. That's the stated rate. That's the amount of interest that we have to pay. Okay. So let's think about as the years go on and we're conducting business, right? If we have a good year, right? We have good sales. Our sales are strong. We manage our expenses very well, and we have a lot of revenue or a fair amount of revenue, right? It's pretty easy for us to pay our fixed costs, right? And we're going to have more left over to pay our stockholders. That makes sense, right? Because remember, earnings before interest, income, and taxes, and EBIT and EBITDA, and everything else that we talked about last semester. We're taking our revenue, we're subtracting our expenses, then we have our bottom line, our net income. Well, from that net income, that's how we pay. That's the money that we use to pay dividends, right? So if we have a bad year, right? We're not doing too well. The economy's down. Guess what? Unfortunately, we still have to pay that fixed interest expense, that coupon rate. Okay. Well, if sales are low, we have still have that fixed interest payment, that big chunk of interest payments. Well, guess what? We're going to have less money, or we're going to have less net income left over that we can give to our shareholders or that we can distribute as a dividend. Okay. So by incorporating leverage, right? Basically, what we're doing is we're amplifying the variation in the earnings per share and the return on equity based on our business cycles, okay, or the economy. We'll get into class looking at the financial leverage, the earnings per share, and the return on equity. Okay, we'll get into looking at ignoring taxes. I think that was M&M Proposal 1, I believe. And then we'll also get into the calculations with M&M Proposal 2, I believe it was. Okay, so we'll get into all these calculations in class. We'll go over EBIT a little more. Please review EBIT. It's in the book. It's earlier in it's earlier in the book, meaning in the chapters that we covered last semester. You should know what EBIT is, earnings before interest and taxes. We'll get into calculating break-even points or break-even EBIT, not a problem. Right now, you should just know what the calculation is, or the formula, so to speak. And then we'll work on calculating it out in class. Okay. We'll talk about homemade leverage, right? What exactly is homemade leverage, right? The use of personal borrowing to alter the degree of financial leverage. That's what we call homemade leverage. Okay. Let's see here. Capital structure theory. Okay. You should know what it is, right? We'll talk when we get to class. I really want to get into more detail of what is this theory of capital structure, right? What's Proposal 1? What's Proposal 2? How does it look like? So please make sure you read those parts of the book. Take notes. If you find anything, if you're inclined enough to maybe find an article or a research paper, great, bring it in, share it with us. Okay. But we'll talk about this a lot more in class. We'll talk about the three special cases. We'll get into, again, in class, talking about the capital structure theory under three special classes, what those three special three special cases, and what those three special cases are. You should know these equations, okay? Um, the WACC should just be a review, right? Because we already talked about that. Um, let's see what else. What else is important here? You should be, again, hopefully familiar and know the CAPM model, and looking at Proposition 2. We'll get into more detail again in class on how these interact with each other. Let's see what else is important that you should definitely read up on before you come to class. As far as all the cases and the math, we're going to work on problems together in class, so just have an idea of what's going on. Bankruptcy costs, right? Really not going to talk about this in class, just want to kind of cover it now. When it comes to bankruptcy costs, we have direct costs, and there's obviously some indirect costs, right? And think about bankruptcy. Basically, this is a fire sale, right? We have no money, and I'm not talking, we're cash poor, or our cash flow. We have issues with our cash flow, which is we have no revenue coming in. We're losing money left and right. So we're bankrupt, right? We've defaulted on some loans. So what are these direct costs? Well, we're going to have legal and administrative costs, right? Obviously, we need a lawyer to get involved and help us file the paperwork so we can claim bankruptcy. Basically, what happens is that when we go into bankruptcy, everybody gets in line, okay? And there's an order of liquidity, but that's really not what I mean. There's an order of payback, of people who get paid back first, second, third, fourth, fifth, right? And we know that bondholders usually are at the top of the list, right? Well, unfortunately, when we claim bankruptcy, basically what we're doing is we're selling off all our assets, and whatever cash we generate from selling our assets, our revenue generating assets, right? We're selling those. We're taking that cash and we're just trying to pay people back or pay people off, right? Not pay them off, but pay them back. And what happens is, especially usually in these types of situations, there's not enough money to pay everybody back the full amount that we owe them, okay? So what's that mean? Well, ultimately that means that bondholders are going to incur additional losses, okay? They have a bond for $1,000 outstanding, and we can't pay them interest. We can't even pay the bond back. We claim bankruptcy. We sell all our assets. They're going to get maybe, cents on the dollar for their bonds, right? Basically, when it comes to bankruptcy, this really is a disincentive to debt financing. However, there's other issues that arise where complete bankruptcy might not be an issue, meaning there's still hope for us, right? Maybe our company's in financial distress, right? We got problems meeting our debt obligations, and usually what happens then is that we don't have to file full-fledged bankruptcy, right? We can file Chapter 11, right? And if I'm remembering correctly, Chapter 11 just allows you to refinance your debts, right? Hey, we're in financial distress. We're having trouble meeting our payments, so we're going to restructure, okay? Some of the indirect costs of bankruptcy, right? Usually these indirect costs are a lot harder for us to measure, okay? They can be larger than direct costs, right? Think of again, when we're talking about indirect costs of bankruptcy, we're looking more at the how can I word this? we're looking at the negative light that sheds on us, right? We lost confidence, right? Even if we just restructure, right? Chapter 11 bankruptcy, right? Maybe our stock's going to take a hit. We're going to have a tough time raising funds, right? In fact, probably aren't going to be able to raise funds because we're going to be restructuring everything. So assets are going to lose value, right? Management's going to be worrying about how do we avoid bankruptcy instead of running the business. So it's kind of a mental aspect of management getting away from business as usual, and more worried about, okay, how do we avoid bankruptcy? What can we do to make it look better, right? Probably going to lose sales. There may be a disruption in our operations. Excuse me. There may be a disruption in our operations, right? We might have suppliers that we owe money to, and they might say, "Hey, you know what? We're not sending you any more stuff until you get your Chapter 11 squared away and you get restructured," right? Think about it. We might lose good employees, right? Companies going down the tubes. We're trying to save it, and we might have some key employees who jump ship. So again, things like that are really tough to measure, especially valuable employees or key employees. We'll work on in class the value of the firm, right? But before we go into that, or before we go into class, you're going to need to know some things, right? You're going to need to know, how do we calculate the value of the firm, right? Marketed claims versus marketed claims plus non-marketed claims. Well, we need to know before we can even talk about it, what are marketed claims? What are non-marketed claims? Well, the marketed claims are the claims of our shareholders and our bondholders, right? The non-marketed claims, those are the claims of the government and other potential stakeholders, okay? So it's important to recognize, again, as we talk about the value of the firm, it's really unaffected by changes in the capital structure, okay? So there's going to be we're going to have this division of value between those marketed claims or claims of the shareholder and the bondholder, as well as those non-marketed claims or claims of government and potential stakeholders. Okay, and the division of value between those two groups are going to have an impact by our capital structure decisions. Okay. When we get to class, again, I'd like to talk in more detail about the pecking order theory. What is it? Basically, it's a theory that says that firms prefer to issue debt rather than equity if internal financing is insufficient, right? What does that mean, internal financing? Well, remember, we're a company, right? We're generating revenue, hopefully. We're subtracting our expenses. We have net income, right? And that net income, hopefully, we keep earning net income year after year after year after year. Well, what we do with that net income is we put it into that account we call the retained earnings, okay? And that retained earnings is what we use to pay dividends, or it's what we use to kind of self-finance, okay, or internally finance some operations. So what the pecking order theory says is that we'd rather use debt than equity if we don't have enough money to internally finance, right? We're going to use, rule 1 says we're going to use we're going to use internal financing first. If that doesn't work, we're going to issue new debt. If we don't raise enough money issuing debt, then we will issue new equity, kind of as a last resort, okay? and again, when we get into class, I want to talk in more detail about the pecking order theory and how it's at odds with the trade-off theory. Okay, so how is it at odds? Well, there's no target debt to equity ratio, right? Profitable firms presumably use less debt, right? Um, and again, it does give companies um, some financial slack, so to speak. Let's see what else is important here. You should know the difference between you should know the bankruptcy process, right? Business failure, legal bankruptcy, technical insolvency, accounting insolvency. You should know what these terms are. You should know about Chapter 7, Chapter 11. What are the differences between the two? Again, ethics, always important, right? Should managers borrow from creditors and issue a large one-time dividend to shareholders? Well, that's probably not ethical, right? Because think about it. Think about it this way. When a company assumes debt, right, or issues debt, basically they're doing that. Obviously, at the end of the day, they want to increase the wealth of the shareholders, but not at the detriment of their bondholders, right, or the banks or whoever they borrow from. Okay, so that would probably be unethical to issue a large one-time dividend to shareholders, right? And think about it this way: the idea is that if they do borrow debt, right, they're going to buy back stock. Okay, well, you might say, well, wait a minute, how's that helping the debt holder, right? Well, think about it this way: there's less owners. There's that, so that pie, that profit pie, doesn't need to be cut up very, very thinly to go to a bunch of people, right? That's number one. So the company owns those stocks, or those shares of stock, so to speak. So there's less dividends to pay out. As far as how can creditors control this potential transfer of wealth, they can always issue something like debt covenants, things like that to make sure that they are prepared, right, or they are covered rather. Don't worry about the comprehensive problem. We can actually look at that in class. So again, takeaway here is just to understand, again, what we're going to do in class, some of the things I want to dive deeper into, making sure that you have some of the information in order to be able to discuss what we're going to discuss. So if you have any questions, again, please feel free and shoot me a text. Totally not a problem. But until then, I will see you guys on Monday.